to put up a chart right now about inflows into TIPS ETFs, which really show a spike up. That's in your piece today.
Unprecedented.
Yes,
and that's why it's so noteworthy, is that, as so many of your commentators have suggested, there's no sign that inflation is accelerating. And even the Fed has been reassuring on that front. So why are investors suddenly acting up? And I think the answer to that is we've seen this motion picture before, and it happened at the early part of the century. We also had a big tax cut coming out of a much milder recession. The deficit started to swell. In fact, we went from a period of surpluses, the only period of surpluses really since the 1970s, to deficits and ever-rising deficits. And then the financial system started to get overheated, and we all know what happened in 2008.
Historically, though, if we see a lot of flows into TIPS, does that actually correlate to higher inflation?
Not necessarily. What it does suggest is anxiety is going up. And so what you saw in the first 8 years of the century was a big spike in volatility, okay? And it started to accelerate. And that, of course, makes investors very uncomfortable, because when there's a lack of certainty and there's more uncertainty, people look for protection. And so TIPS became a refuge. And we're seeing almost exactly the same thing now.
But is it a different motion picture? You say we've seen it before. Is it a different motion picture? We have the advent of technology that we really didn't have before. We have reduced, apparently, bargaining power on the part of labor, which is really suppressing. So might it be different this time?
It could be different. But here's what we're seeing is greater imbalances. You're going to get a bigger and bigger budget deficit as a percentage of GDP. At some point, that's going to make investors much more uncomfortable than they already are. So that is the same as what we saw at the beginning part of the decade. The other thing is inflation is going up. It's not going down. And it did go up substantially from where it was under Clinton to Bush. It exceeded 3%. By the time we got to 2008.
Yeah, and just to sort of also talk about why it can be so important. If you come inside the Bloomberg, this is the real yield for 10-year TIPS, and we're kind of flirting with potentially hitting that 1%, which we really haven't hit since 2013, and that's where we have real implications for the economy.
Yeah, I mean, look, everything is great right now, and the time to sort of think about what could go wrong is when everybody's feeling great. I mean, that's actually historically what the Fed's supposed to do, is when everybody's enjoying themselves, you take away the punch bowl.